In the world of finance, few people carry the long-term wisdom and steady temperament of Warren Buffett. At 94 years old, after living through 15 recessions and more economic crises than most investors will ever see in their lifetime, Buffett understands something essential. In certain moments, preparation matters more than prediction. And right now, as we move closer to 2025 and 2026, he's seeing familiar warning signs, patterns he has seen before some of the most challenging periods in modern economic history. The good news is this: if you're retired or approaching retirement, Buffett believes there are 5 specific investments you should own before 2026. They're not flashy. They won't make you rich overnight. But they do something far more important. They protect the wealth you've spent decades building while giving you the stable income you need for the next 20 or 30 years. And these are not just theoretical ideas. Buffett has personally relied on these principles to preserve and grow wealth through every crisis since the 1950s. Before we dive into the 5 investments, it's important to understand why 2026 is such a critical deadline. We're living through a rare economic moment where multiple forces are converging. Interest rates are the highest they've been in over 15 years, and they're unstable, which creates the risk of policy mistakes from the Federal Reserve. At the same time, the baby boomer retirement wave is accelerating. 8,000 boomers retire every day, turning from contributors in the market into net withdrawals, creating persistent selling pressure. And on top of that, government debt has reached levels that will force difficult decisions, either letting inflation erode debt or raising taxes. Both scenarios put retirees at risk. Buffett learned early in his career that the best time to prepare for a crisis is before it arrives. In 2006, when he saw the housing bubble forming, he quietly shifted into safer assets. Many people thought he was overly cautious. By 2008, they understood. And right now, Buffett sees similar signs, and the adjustments he's making to his own portfolio are the same ones he recommends for retirees today. The first essential investment is TIPS, Treasury Inflation-Protected Securities. TIPS are unique because their principal adjusts with inflation. If inflation rises, your principal rises with it. This protection matters because traditional bonds suffer badly during inflation. A 10-year Treasury paying 4% loses purchasing power every year if inflation averages 5%. Buffett witnessed this firsthand in the 1970s, when inflation destroyed the retirement plans of people who believed government bonds guaranteed safety. What once bought a nice dinner could barely buy a sandwich 10 years later. TIPS prevent this erosion. For retirees, allocating 20 to 30% of the bond portion of a portfolio to TIPS, ideally laddered across multiple maturities, creates both protection and liquidity. They work best in tax-advantaged accounts since the inflation adjustment is taxed annually. The second important asset is Dividend Aristocrats, companies that have increased their dividends for at least 25 consecutive years. These companies sell the products people need regardless of the economy: toothpaste, groceries, household goods, medications, basic everyday essentials. When costs rise, they can raise their prices. When the economy slows, demand remains. And the result is a steadily rising stream of dividends. Buffett values dividend-paying businesses because the consistency of their payouts reveals something most investors overlook: management confidence. As an example, a retiree investing $300,000 into Dividend Aristocrats might earn around $9,000 in income at a 3% yield. But if dividends grow by 5% a year, that income becomes nearly $14,650 within 10 years, and almost $23,850 within 20. This rising income stream helps retirees keep up with inflation without having to sell assets. The third investment retirees need before 2026 is short-term Treasury bills, specifically those with maturities between 3 and 12 months. Many people dismiss T-bills because they don't offer high returns. But their purpose isn't high returns, it's stability and flexibility. T-bills are backed by the full faith and credit of the US government, making them one of the safest assets in existence. They mature quickly, provide liquidity, and right now they offer yields around 4.5%, which is unusually attractive for such a low-risk instrument. More importantly, T-bills give retirees what Buffett calls optionality. When they mature, you can reinvest, hold the cash, or seize opportunities in a downturn. During crises, the investors who stay calm are the ones who have liquidity. Those who don't have liquidity are the ones who panic. Buffett recommends retirees keep 15 to 25% of their portfolio in short-term T-bills, not for growth, but for peace of mind and financial agility. The fourth investment is immediate fixed annuities, a tool that Buffett believes solves one of the biggest risks in retirement: outliving your money. An immediate fixed annuity pays you a guaranteed monthly income for the rest of your life, no matter how long you live. If you live to 100 or beyond, the payments continue. If the market crashes, the payments continue. This kind of certainty is something no other investment can offer. Buffett suggests that retirees between ages 70 and 75 consider placing 20 to 30% of their retirement savings into an immediate fixed annuity, just enough to cover basic living costs when combined with Social Security. For example, a 70-year-old investing $150,000 might receive around $900 a month for life. This income floor ensures that even if markets drop or inflation rises, your essential needs remain covered. The remaining portfolio can then be used for flexibility, growth, and unexpected expenses. The fifth and final investment category is utility stocks and consumer staple stocks. These companies provide electricity, water, gas, groceries, household products, and other essentials people continue buying, no matter what's happening in the economy. They have steady demand, strong pricing power, and reliable cash flows. They often pay consistent dividends and experience lower volatility during market downturns. For retirees, Buffett recommends allocating 20 to 30% of the stock portion of a portfolio into this group, either through individual stocks or diversified ETFs. These stocks won't outperform during bull markets, but they provide invaluable stability during uncertain times. When combined, these 5 investments form a powerful, balanced retirement portfolio, one that delivers safety, income, inflation protection, liquidity, and psychological comfort. It's a portfolio designed not just to survive, but to remain stable through unpredictable economic conditions. And Buffett stresses the importance of making these changes before 2026. Interest rates could drop, reducing the benefits of T-bills, tips, and annuities. Markets could become volatile, making it harder to make rational decisions. Tax laws and retirement regulations may shift. The window of opportunity is now, while conditions remain favorable. Finally, Buffett emphasizes that this is not a set-it-and-forget-it strategy. Retirees should rebalance annually. If stocks rise too quickly, shift some gains into T-bills or bonds. If T-bills mature and the cash isn't needed, reinvest. If dividends grow, decide whether to reinvest or keep them as income. Rebalancing keeps your portfolio aligned with your goals without relying on market predictions. Throughout his long career, Buffett has seen too many retirees take unnecessary risks in their 60s and 70s, chasing returns, falling for promises of high yield, or putting too much money into speculative ideas. And many of them paid the price later in life. Buffett's message is simple: don't let excitement overpower safety. Don't let greed replace prudence. Don't gamble with the money you rely on to live. By owning these 5 investments before 2026, retirees can protect their wealth, secure stable income, and enjoy peace of mind, free from the constant fear of market swings and economic uncertainty. That peace of mind is, in the end, the most valuable return on investment you can ever earn.